Welcome everyone. Thank you for coming out. We have a very special guest here, Eric from Ramp. As we try to do for these panels, hopefully we will make this interesting, maybe make it a little bit spicy. I have a bunch of ChatGPT inspired questions here. And Eric kind of said that, well, maybe I should have had ChatGPT inspired answers, but he's actually answering it live. But we'll also keep this interactive. It's a small enough crowd. That's kind of the reason why we do it in here, such that if you have questions, feel free to just raise your hand. I'll try to tag you in if it's a good time. But let's make this interactive and let's make this fun. So, Eric, as you know, SPC, a lot of the folks here are at the very earliest stages of their founding journey, and they're trying to figure out kind of like what to learn. What areas to explore, what to work on, with whom. So they're kind of dealing with a lot of both kind of the excitement of the possibility, but also the abject fear of kind of like the unknown. So I'm always really interested in knowing what were the earliest days, days minus 100 to 0 of Ramp like. What were you? How did you approach it? From an intellectual place, from an emotional place. Walk us through the very earliest days of Ramp's journey.
Yeah. First of all, just thanks for having me here, and hope this is interesting. Definitely feel free to catch me, dive in with questions if there's parts that we want to unpack. I think before even getting to the first day, negative 100 to 200, I think part of the Ramp story actually came really from the predecessor startup. So Ramp is my second startup, and the first one is focused entirely on trying to help consumers save money from things they buy online. Fast growing, a little bit harebrained in some ways. The premise was basically if you buy something online, Amazon, Macy's, Best Buy, whatever, and the price drops, they all had price adjustment policies and you could get the difference back. And so we built what eventually turned into the largest non-productivity Gmail app that did this for customers. So you link your email, we'd see what you bought, we'd check the prices, and if you were eligible for money back, we filed a claim. And we launched that in May of 2015. Within a year, we had almost 1 million customers, and so if anyone was interested in consumer growth loops, referral, all that, I'm happy to get into it. But grew rapidly, and we had a life-changing offer from Capital One. Originally wanted a partner, then it made sense, actually maybe they should buy this thing, bought it. We ended up there for the next 2.5 years. And we got to see up close how to turn data into savings at scale. Felt we were scratching the surface, even though we're saving over $100 million a year. We ended up in the credit card division, so we got to learn the trade, how credit cards work, what made them a great business, what to think about in operating as a large-scaled regulated entity. And there was something that just gnawed at us. And we were trying to figure out, we were the savings people, and we were trying to get customers more value. And most of our colleagues were thinking entirely about the question of how do you get customers to spend more so they could earn more, and the meanwhile devaluing points in the background. And more, as we started interviewing customers more and more, we'd ask them, did you want points? Did you want cash back? Did you want something different? And if we really listened, we'd hear from customers, actually they'd say, I don't want cash back, I don't want points, I want more in my bank account. I want to be better off financially. And we got obsessed with this idea of what if there was a card and software that was fundamentally designed to help you, the customer, spend less. You could compete on the basis of value and over time break away from price-based competition. But now we're at the negative 100 to 200 days. Okay. We're on it, we're obsessed, and we're trying to figure and map that out.
And so this obsession starts while you're at Capital One.
That's right.
Okay.
That's right. Where I think it started to take an interesting turn was starting to think through, okay, we want to help people spend less. What's the right form factor? It's possible we could do a little bit of a Paribus 2.0 and just have savings insights, but we knew, okay, we'd be quite limited in terms of the suggestions. As we get a glass pane looking in, you could see the savings, but our only vector was send an email and see a response from a store. Monetization was rather limited. And so part of the idea, Maze, we're trying to figure out what would be a clean and simple solution we could get to market with that would have its own sensible monetization, would be simple enough that you could actually save, and I'll get back to how do we constrain the problem, And over time, we thought there could be a there. If you scale the thing, does it get better? One of the problems we had at Paribus was the larger we scaled this consumer app, some retailers loved us, others hated us. Actually, and fundamentally, it got more challenging at scale. And so we were trying to think through this model that if you scaled it, it actually got better. And what we concluded on more and more over time is we started meeting with, first it was, do we do a consumer card? Do we do a business card? We concluded pretty quickly the gap in the business side was very little innovation, but a lot less regulation, so you could actually move quickly in a space without so much, frankly, proper regulatory concerns that consumers have. Next, in a credit card business, one of the primary costs or the ways that you can lose and blow up your business is taking risks that you don't understand in a major way. What was very interesting as we were researching was if you look at the loss profiles, you can find this in 10Ks and annual reports. For consumer cards, you could have single digit to even low double digit losses of every dollar you put out. For corporate, Amex was losing 20 basis points, 10 basis points per year. And so actually, if you could extend credit in an efficient way, you wouldn't need to worry quite as much about that loss profile. And actually, you could start getting into the pure play. We'd extend a card out. We could uncover where companies are spending too much money. It could be a loop of we try to say, we're going to come back with personalized advice of ways that you can actually cut down spending. And if you think these are valuable, maybe you'll try out our card. And so originally it just was a very simple, we were a simple credit card with 1.5% cash back. We would try our best to save you money, and we would try to help you close your books. And so it was just very much understanding and breaking down barriers of what really is the most simple model that we could start chasing down. Happy to unpack some of that. Does that make sense? Does that kind of fall?
It does. So maybe let's zero in on one part of that, kind of like the that obsession phase, right?
Yeah.
Like, what did that look like? Is it this like you obviously probably had a big role at Capital One. Yeah. You probably had a bunch of roles and responsibilities. But did you just find yourself coming back to this particular problem, like working whatever nights and weekends?
Yeah.
Like, is that really kind of the expression of the latent energy for that particular idea? And maybe to also ask, like, is there a reason why you didn't feel like you could do it at Capital One?
It's both super interesting questions. I think I'll take them in order. On the first kind of the obsession part of it, we were really interested in this idea of could you actually help your customers spend less? We were interested in, we know interchange is very valuable, but the hard part is historically it's been a lot of price competition, some kind of race to the bottom. And as a smaller, not well capitalized startup, starting out of an apartment, competing on the basis of price wouldn't be our advantage. And so the early obsession was we met with over 100 founders, finance teams. We started to go deeper and we said, look, we've got this idea for a credit card that tries to help you spend less. We can tell you about that, but I'd love to understand, are there places in your business you feel you're spending too much money? Is there waste? Are there parts of just your closing process that are taking too much time? And we started to follow and see where things went. And it was all kind of, you'd find some things that were very niche, but the more people you talk to, you would actually start to see repeated patterns, some which were very complicated, but others which were quite simple. One of the first kind of aha moments for us was, we talked with multiple startups that actually, they were growing rapidly. This was still like the Uber, WeWork, GoGo days. Grow at all costs. They're different. They're fun, but I think there was one company, I won't name them, but they were using 7 sets of project management software. They were simultaneously paying for Jira, Asana, Basecamp, Trello,
Workday,
all this stuff. It was just like, it was nutty, and it turned out actually that's a common thing that happens in companies as you're growing quickly. And so we figured, okay, well, let's build like a very simple, clustering model to figure out what are these merchants. If you could go and actually, a dollar not spent is 100 times better than getting 1% cash back.
Right.
And so we started with like a very clean and narrow definition of it. And so the initial obsession was on, I think what people often try to do is say, I've got an idea for a business. Can I sell it to you? Would you buy this? How much would you pay for it? Versus, tell me about the pain that you have.
Right.
How can I solve this problem for you? And see where it goes. And by the way, our savings recommendations is we'd go through by hand, we'd look through, statements, spreadsheets of past transactions and do it manually. On the question of why not do this at a big company, some of it had to do with experiences that we had there. I mean, it was almost like being on a cruise ship. Like, that thing can carry a lot of weight, but if you want to turn it, it's like a mess. And any new product that you're shipping, the governance would be multi-months for anything, whether it was changing the color of a button or shipping a new feature. And our view is, if you really looked at the need sets, talking to customers, the problem was not, can I get a credit card? The problem was not, can I get expense management software? The problem is, like, I can't close my books without using 3 sets of software, and this is a product issue. And so we identified it was a workflow and product problem, that if you could solve that, you could have the monetization and just the rich profit pools accessible to credit cards. And so even a different way of kind of the insight that we had was you could monetize like Amex, but solve the problems that were stuck at, like, the Expensify's, Concurs, Bills.com of the world. And if you could do that, you could almost compete with this large LTV profile against folks with a very small CAC and LTV capability, and continue to use that for more and more sets of software. And so we started to see actually how it solved customers' problems, interesting business on its own right, and actually start to set up these positive feedback loops the more you scale it.
Interesting. One of the things that we often talk about at SPC, maybe as almost like forced dichotomy, is this idea of like a top-down ideation, which is really like, you're kind of starting off with like big markets, and you're doing market analysis, and you're going out and trying to understand like broken market structures.
Totally.
And then on the flip side, which is very much just like bottoms up, right? Like, hey, don't think that much about the market. Just start hacking. Just build something, right, and see where it goes. And just like build it for a week. Are you more excited? Build some more, right? Yeah. And based on what you're saying, it sounds like you did both, which I think is the right way to do it. Which is, it sounds like you weren't completely top down, but it also seemed as though you were kind of constantly iterating on a base product. Does that sound right?
That's 100% right. And I think like the mental model I try to have with this is, as you're discovering the market, you want to be testing all your assumptions to get to a clean business equation. You want to figure out, if you design a simple product and you can't design multiple, you might only be able to design one. Of course, you can layer on more of how will you make money? What are the embedded assumptions all the way through? And for us, it was simple. Could we actually, are we too crazy, or is it possible to create a credit card?
Right.
If you can create a credit card, how do you finance the thing, and can you do it at an effective rate? How do you cover risk? And can you solve a problem? And actually, once you kept distilling and cutting, it turned out there was about 3 core things we needed to get right. We needed to be able to issue a credit card and that people would want to use, that might save people a little bit of money or a little bit of time, enough to get them to go for it. And last, could we sell the thing? If it turned out the answer to these things was correct, your model was sufficiently built out that you knew there would be a business on the other end. And then all your effort starts going bottoms up to, okay, what does it take to sell this thing? What does it take to deliver value? What does it take to make sure that it constrains the problem really nicely?
Right.
And so that's why I think some view of both ends.
Both ends make sense.
Helps.
That's awesome. So, I'd say that most successful founders that I've worked with tend to either have an intuitive or explicit understanding of their own strengths and kind of like their own superpowers, and they kind of, if they're explicit about it, they start really like shaping it and honing it, and kind of in some ways like sharpening their own knives. But sometimes it's just intuitive. So what would you say your biggest kind of superpower is?
It's a good question. It's changed and evolved over the years. So I think I do try to think a lot about how do you simplify assumptions
Yeah.
in focus just on a couple things that matter. There's many different, I mean, maybe a mean way of saying is maybe there's a laziness or an unwillingness to do 100 things, but I'm the kind of person where if there's 100 things to do, there are real people out there that like, you give them 100 things, they will like stay up until 3 a.m. trying to get 80 things done, 90 things, as much as they possibly can do. My natural state is like, I would rather do 3 to 7 of the most important things, or maybe just the 1 to 2 most important things, and totally drop the rest. Which made me not a great employee, I think, at times in other jobs. I was almost fired from my first job for doing stuff like that. But in the context of trying to build a company, the world is very asymmetric and kind of like that. And I think that the job of founders is in a very messy world that you could literally be doing anything in the early days. You could do market research, you could go be selling, you could try to raise, you could try to get media, you could try to go meet a co-founder, it's almost too much, too many things that you can do. That art of trying to constrain the problem and simplify down, I think, is super important. The other thing, and I think contrasts and very varying skills, so long as you have mutual values, works well. Like I tend to be more, calm, let's give things kind of in time, whereas Kareem and Gene, or some of my co-founders, have very different spikes. Like Kareem grew up in Beirut, Lebanon, where there's always something that's going wrong. There's always issues. You need to be thinking ahead, moving extremely rapidly. Gene is one of the people I know who learns faster than basically any other person I've ever met in my life. There was different reasons for why we wanted to work together, but I think people have their own superpowers, but trying to make the space for like what is yours, and how do you hone in on that, I think it's useful. It's good. Yeah. It's a good exercise.
It's a common trait of great founders, also not great employees. Yes.
Yeah.
This as well. Yes.
Yeah.
But you mentioned this, but I'm going to ask it explicitly because it sounds like you do have a point of view on this. Given this extraordinary ability to kind of like focus and to find clarity in what you want to get done, what do you think are the big there's often, it's like every great strength also comes with a bunch,
Totally.
an associated weakness. So what have you found over the years? Like, what does this superpower lead you to fuck up?
Totally. Look, I think Kareem Speculator has been like such an incredible contrast for me in it. Like I tend to be much more trusting of it's going to go the right way. Give it time, give it space. And I think that gets a lot of companies into a lot of trouble really quickly. When you give people like large mandates, you make huge assumptions, and you don't actually inspect it consistently, figure out what are the leading indicators and how are you going to be as rapidly as possible, understand if you're right, if you're wrong, or how to pivot. I think I can often, I've gotten better over the years, but can very much get caught flat-footed. And I think, I'll say it explicitly, I know that's a gap about me, and often I try to find folks who more and more my role turns out, maybe you don't need to do top 100, but the next 50 are very important in finding people who are operationally excellent, and also people who explicitly are world-class at making sense of inspecting very, very deeply. And I think one of the things that people say about Ramp's culture is like, we are almost militant about understanding what are the leading indicators that are going to match to the lagging, and how do we inspect deeply at multiple levels of the organizations what's actually happening, and are your assumptions correct? And that comes from leaders of the company who have superpowers that I don't.
Interesting. Yeah, man. I am a hopeless optimist. Like, when I look at an idea, I'm just like, these are all the ways this is going to be amazing. This is why I work with Mitra, who keeps me in check. Okay, we will intersperse some spicy take questions in between regularly scheduled programming. So what is one technology trend that you hate?
Oh, geez.
Don't say crypto. Too easy. Yeah. Also too soon.
Look, to be honest, I'm very much a fan of what's happening in AI. I think it's like very revelatory, but I think as I'll just say it, especially at places and I think with hyper smart people that really deeply understand technology, I think there's a lot of people who like take technology and try to like go find problems with it. And I think I've basically never seen that work well over the long run. There's maybe if you're building a new database, that works sometimes, or fundamentally new breakthroughs. But other than that, like I just don't see that working. And so I think one of the traps for most early stage companies and a trend I hate, like among seeing with founders, is fucking brilliant people. Sorry, like
it's great.
Just like actually being like, we've got AI. What industry is this going to revolutionize, and then just go like straight into it without like validating, understanding. Like, I think the world is often very efficient and actually makes sense. Like competitors are smarter than you think.
Yep, for sure.
Processes that look disastrously inefficient or industries that look totally messed up, there's probably a good reason for why they were. It doesn't mean necessarily it will be going forward, but assume people are smart, and rather than taking technology, I think in this one there's a lot of people who are wasting a lot of time with AI. In areas that shouldn't work. I also think like it's amazing, so I don't hate like it's probably maybe only a half answer to your question, but
no, it makes sense. I mean, I think the way I tend to think of it is that most people, and I, as somebody who tends to again see the best side of everything, I've learned over the years that even if you build something that's 2 or 3x better, most people aren't going to switch their workflows.
Totally.
Because what they have kind of works for them, and it's not just about you, it's about the whole organization or the other organizations that they work with. And it's just really easy to aim for 2 or 3x, and it's just really hard to do like a 10x actual better product, right?
Yes.
And I think AI, like a lot of the applications today seem to be, hey, I'm going to throw AI at this one thing, but guess what? Your competitors, like your incumbents, are going to do that faster than you, maybe, right? So I think, that's a good answer. Okay, so maybe going back a little bit more to your personal story. I'm curious, what is the best piece of advice you've ever received, and how have you applied it to life and work?
It's interesting. I mean, I think in the context of like company building, I need to think a little bit more about like what's the personal one. Like there's a few one that have changed my life, but when I think about like I think Y Combinator gets a lot of it really, really right. Of like the one thing that they try to constrain the problem on is once you have a business you're focused on, is try to grow a certain percent every single week and hold yourself to that standard. And the reason I'd say that is first, like a lot of people just are restless and want to 10x everything, 100x stuff, and grow things out of proportion. And I think first, you want to stop yourself from taking massive swings. You want to figure out every single week, how do I grow 7%, 10%, whatever's the number, but do that consistently. And I think when you do it, it just makes the optimization problem like very clear. Of in order to grow by 20 users, maybe if that's your goal you're trying to optimize this week, it becomes much clearer. You can probability weight what is going to get you there and actually focus things. And you can see problems coming out in front of at some point when that metric is you need to add 150 users. You can see that's coming, that's 8 weeks away, whatever many weeks away it is. And you can start planning for it, but you can focus on the here and now. And I think a lot of the way that we see ramp, and we're known for, we just announced today we grew 4 times year over year. We're the fastest, growth in our industry. A lot of that came from 5% improvements, 2% improvements, 10% consistently, constantly. And a lot of that came from trying to really focus on what is the one metric we're trying to move, how do I be consistent on it, and how would I constrain what is a completely messy idea maze of stuff. And so constrain the problem is probably like the best business advice I've ever heard. I still try to think about it every week.
Any personal ones?
Any personal ones? Look, I think I tend to operate in a lot of like pretty hard charging environments with people who like really are trying to push. Sometimes like, I tend to be more even keeled. There are people who are like restless to get things resolved, and I think sometimes that'll break out in like very different views, and sometimes like fights, friction, all that. I think for me, I think I'm trying to think about how to articulate this. Saying like assume good intent isn't quite enough. I think it's more of like if you have a different view with someone, presuming there's common goals, and hopefully within a company or between companies trying to work together, there should be. You want to be trying to like uplift versus outsmart. I think when people get caught in disagreements or different ways of viewing the world, it's very easy to get stuck in the like, have like ego speak for you. Like, I'm right, you're missing this, why aren't we doing this, is where things tend to evolve. And actually trying to make the space to step back and say like, what do we agree on? Great. We're trying to solve that. How do we actually get there together and remove? And sometimes like, you got to take it on the face and eat shit when like I'm wrong sometimes, and like that's a good thing. It's not about who's right and who's wrong. It's like, how do we actually achieve the goal? Because so I think a lot of it has to do with how do you uplift versus outsmart is where I found the most useful in just like my whether it's like work life or even just like personal life of like healthy relationships. You're going to have arguments and different views of the world, and finding that common ground helps.
It's really good advice, actually. I'd say that I was just thinking, I have a strong-willed partner, my wife, and kind of the best piece of advice that our couples therapist gives us is you kind of have to, instead of doing no but, it's always yes and.
Yeah.
Kind
I
of
love
just like
that.
start everything with yes and. So, and not just for the sake of getting your point across, but actually acknowledge and internalize what they're saying to get to the next, hopefully, plane of the discussion.
Love that.
And even your previous point, now I really love the way you articulated it, because looking back, the teams at Facebook and Dropbox that were the most successful were not the ones that said like, hey, I'm going to 4x or 3x this metric. They were actually the teams that, like Facebook growth is actually the best example. Like for the up until like 200 or 300 million users, it's like clockwork. It's about 2.6% week over week growth. Yep. And if that deviated plus minus like 20 bips, then we had an issue, right? Like if it's too high, it might be spam. If it's too low, we also have an issue. And it was just like, and we never actually set, it's crazy at Facebook, we never set like the top level goal. It was just like every week, this is kind of what we need to hit. And at Dropbox, the version of it was actually the SMB growth, which is like how many SMBs will start using at Dropbox. And it's interesting. I love the way you articulated that. Yeah, thanks. Thank you. So maybe switching gears for a second and talking a little bit about kind of just the New York kind of like startup kind of ecosystem. I've worked with a bunch of New York companies in the past, but I've never kind of like deeply kind of been part of the ecosystem here. So I'm curious, like how would you describe it to, like how would you compare and contrast kind of like the early stage technology ecosystem here versus like, I don't know, San Francisco or ChatGPT said Boston. I'm like, why are you saying Boston?
Oh,
so,
yeah.
So it just so just like San Francisco.
Feedback, yeah.
Yeah, like, give it feedback. San Francisco, New York. Yeah, so San Francisco versus New York, maybe. Yeah.
It's I think it's an amazing time to be building in New York, and it's changed so much. I mean, so first, like, fast-growing startups are very bizarre in like a few key ways. Of like, most companies are profitable. People forget that sometimes in the startup system, but that's one. And they don't grow that quickly. It's very weird and very unusual, and actually like an anomalous experience for anybody to be part of a company that's like doubling revenue every 6 months or a year or 3 months or whatever. And I think for a long time, functionally, San Francisco almost had a monopoly on this, and it wasn't. Right. It's hard to explain to people. I'm sure you had this experience, like what it feels like to be inside a Dropbox when the place is at scale, doubling every 4 months, and how it breaks marketing teams and breaks engineering teams and breaks design and the funding requirements that starts going to how it. There's almost an art of constantly reinventing yourself. Right. And so, practically speaking, I think for a lot of the past few decades, if you really wanted to start a company that looked like that would be venture funded, that would grow that quickly, there was one place that you should go, and you could find people that you could hire into your company, and they were almost all entirely in the Bay Area. What happened over the past 10 years, 15 years in New York was, for the first time, you actually started to see extraordinary tech companies really built here. Whether it's in, the DoubleClick to MongoDB to Datadogs to some of the consumer DTC brands, it started to happen. And so there are people who saw it go well or saw it go poorly here. You started to see extraordinary engineering-led companies build huge offices out here. Amazon, Google, Meta,
Facebook,
Dropbox, Stripe.
That's right.
People who knew what it was like. They were there for it, but for personal reasons wanted to be out here. And these weren't small offices; these were huge.
Right.
And so I think what happened even prior to the pandemic was you started to get a critical mass of extraordinary people who knew what it felt like across functions actually here, but there hadn't been these truly large-scale breakout companies built. And I think right now is an amazing moment for New York to do that. Even part of the vision for Ramp in the early days was, if you were to ask an engineer circa 2018, 2019 of, okay, I want to work at an extraordinary engineering-led FinTech company, where do I go? I'm sure 9 out of 10 people would tell you Stripe, maybe 99 out of 100. It was kind of the thing, and how could we create that destination for extraordinary engineering, extraordinary product design, fast growth, but done here and done right in New York, which is the financial services center of the world. It made sense, and so I think there's a lot of extraordinary industries that are ready, and I think this ecosystem has not only benefited in a huge way through the pandemic, but I think it's an amazing place to do it. And look, I think we were talking prior to even the session about the cultures of, do you default trust or do you default distrust? And I think for a long time in New York, there was a lot of just sharp elbows, and very zero-sum thinking of, there's only one of us who's going to make money, and it's going to be me, not you, kind of a thing. And I think how do we help each other, give each other advice and collaborate like a real center of communities developed. It's not quite like San Francisco, where it's everyone you meet sort of works in the industry and is helping, but I think, frankly, even communities like this are a big part of, I think, changing the ecosystem for the better, and I think New York is going to be one of the important centers of startup creation over the next decade. I really do.
Amazing. Yeah, it almost feels as though that there might be the next level of scale in terms of maybe density of talent, kind of like a shared almost knowledge base, a shared almost cultural kind of base that seems to be emerging. If you could give one piece of advice to kind of like somebody moving out from the Bay Area to kind of like try their luck, in the big New York City, what would you tell them? That is specific to New York, maybe something about sharp elbows, I don't know. Yeah.
It's, I'd want to know the person and know, like, why are they moving here? What are they into? I mean, I think, I've been in New York for 11 years. Part of what I love about it is, like, there are so many different, like, ecosystems. It's like, it's not a monoculture. And, like, if you want to meet the people working in, like, fashion or banking or, like, hipsters out in, I don't know, Crown Heights, like there's many different types of people and things that make people like tick, and I often think like startups and starting the company is trying to find some deeply weird and specific niche, and like giving yourself the space to like actually explore, because like it's a funky city, there's interesting stuff going on, and like do that, explore around, like even neighborhoods, you cross over a few blocks and it's completely different feel. Don't settle too quickly. I think there's other cities that you can really wrap your arms around what's going on in like a few months. Not here. Like I feel like even I've been here for over a decade, I don't totally get all the things that are going on here. So give yourself some space to enjoy it and explore.
It's interesting. Yeah, I think that all the kids out here from, who haven't been in San Francisco back in 2004 and 5 when I moved out to San Francisco, the place was super weird, right? Mm-hmm. Like people forget that San Francisco only became the way it is now, which is frankly pretty loud as a monoculture, over the last 6 or 7 years. But prior to that, the city was like, all of the shit that they say about San Francisco, it's like, it's been there since 2004. It's kind of just like a slightly grimy, it's not the most well-run city. It's kind of got its pockets of like crime and stuff. But it always had like this underbelly of like people doing like funky things, which I found really inspiring, because you could go and get, there's like your point about a startup kind of being a almost like a contrarian counterculture to what exists in the world is very right. Like that's kind of what when people talk about the camaraderie of like a startup, it's like, hey, we believe something that most of the world thinks is pretty dumb.
Yep.
And we are kind of at the vanguard of believing this stupid thing, but like at least we're in it together. Like that's kind of the camaraderie. So you can find that when you go to these subcultures, and I do find that San Francisco has lost that now, which is a shame. But maybe it'll come back, maybe it'll come back in some way.
Maybe that's the contrarian bet.
Yeah, that is the contrarian bet. I'm still there. Yeah. Okay, so let's see. We'll do a few more questions, and I think we'll have plenty of stuff from the crowd. Any advice? I mean, maybe this is not a particularly relevant one for you, but I'm going to go for it. Sounds like you knew your co-founders for a while.
Yeah.
Like, so the question really was like, for people out there, what advice would you give to people who are really kind of like trying to figure out, like, optimize or think about who to start a company with, right? Like, should you prioritize people that you have known for a while, so you kind of have that inbuilt trust? Should you try to find people who spike at different things that you do? Like how would you, what advice would you give?
Yeah, I mean, look, even though I've known my co-founders for a long time, you don't really get to know somebody until you like go through it with people and actually try to build stuff. And even so Kareem and I had started Paribus, the last company years before together, and we were probably a little bit more risk adverse. He was on a visa, had to manage and make sure we were really careful about when we started and what needed, what needed to happen. We worked on nights and weekends for many, many months, and you often can tell if you can figure out if do I actually agree with someone? Can we actually have a simple view? It's like, what are we trying to optimize? Mm-hmm. When you work together, do you get stuff done? Do you call them up for advice? And I it's going to sound trite, but I think one of the most important things you can do with someone, if you think there's a chance, and we figured out Spikes, and I learned a lot about him, and he learned a lot about me over years, and we were at different times at each other's throats. You figure things out by actually going into the arena, actually trying things together. I think it's exceedingly rare that there's early on, someone has a brilliant idea, and once you've shared it's out of its bag and you've ruined it because you've worked with some other person and they stole your idea. Practically, it's cool for Hollywood.
It's never happened.
I don't really know that ever happening. Usually people are too busy, have too many other things, and startups are too hard.
They're ridiculously hard. Yeah,
they don't work most of the time. They just don't. So it's very rare that you can meet the exact right person who's going to crush you at it. They're way better, and you're going to be fierce rivals. More likely than not, you're going to figure out actually, do you want to go make this crazy bet for years together and form this strange marriage where you can't really divorce the other person without getting into a legal, I don't know.
There's a lot of trouble, yeah.
It's, so I would say, I honestly think just try it, and if you're into it, it feels right, go for it. And I think next, I think back to the question that you're really getting at is what are your spikes? I mean, when you get past the functional, does someone have a particular skill set that you think is weird but relevant to it? I think one of the best analogies for early stage startups is they're kind of like an F1 car. They look totally bizarre. They don't really last all that long. They require a lot of maintenance, but it does one thing and one thing well, and it goes for this short race as fast as possible, and it's ready to just break apart and explode at the end of it. That's kind of more what you want if you're thinking that versus Toyota Corolla, ready for all situations, good mileage. Go with the racer, and hopefully the next round of funding, whatever you need to, you prove your hypotheses, and it's fine to have totally deficient, warped vehicles, warped companies. That's fine.
Take turns at 200 miles an hour. It's really, whenever anybody asks me hey, how do I know if this is the right person? And I kind of say this in jest, but I'm just you should find the most stressful situation that you can manufacture safely.
Love that.
And then put yourself in it, go diving with sharks, go skydiving. Because everything is fine. You can get along until shit gets really stressful. And then the question is are we compatible under moments of super high stress? Will somebody provide the calm? Will somebody provide kind of the bias for action? And that's hard to kind of understand until you're really in some crazy situations. So I don't have necessarily safe ideas to try this out, but I think that it's worth thinking about. Okay, we have about 10 to 15 minutes maybe. Let's get some questions going. Victor, first draw. Yeah.
Well, thanks again for doing this. And Ramp has an incredible reputation for the talent that works there. And one of the questions I've always had for any company of that stature is, what were the things that worked very early on for recruiting your first 10, 30 employees and retaining them? What worked for identifying that talent and bringing them in, especially before there was a strong reputation around the success of the company itself?
It's a super good question. I guess if folks listening in, the question was, how do you think about building strong talent in the first 10 to 30 and making it somewhat self-fulfilling? Is that a fair characterization? Yeah. So I think I would go back and think about the psychology of even when you've looked at different companies or employers, of like, probably one of the first things you might do is like go on their LinkedIn and see who else is working there. And I'm sure sometimes you have the effect of like, whoa, this is interesting. Like, these people are fantastic. Or there's been other times you go and you look and you're like, this person's not that impressive, or I don't get the spike. And it's not to say just look for people with credentials or a certain way, but I think sort of know that there's a lot of self-perpetuation in terms of what you hire for, and how it looks can often dictate and drive results down the line. And I think in that context, thinking about how do we, back to our F1, specific spiky people who have particular skills that can help us get down to like the leanest, MVP to get this product out. But how do you find people with like a really extraordinary ability in certain ways, or really strong spikes? I mean, maybe on their own, right? It's first helps you get there and get traction, and growth tends to solve a lot of evils in a business, tends to solve a lot of problems. But it actually makes recruiting. I think a lot of people want to work with and be a part of amazing communities, work with amazing people, and so designing explicitly for that early on, I think, can go a very long way. I think the next one, and this is a little bit dangerous advice, I would say use it sparingly.
Yeah. Now I'm settled in. Okay.
Yeah, like, cool. Right. It's like, so something really, with first startups, most people's intuition, and I think it's actually very warranted in many cases, is like, it's going to be about scarcity, making like every dollar count, and like it could go out the door. So like, do not waste a single dollar, and like make it up in times, right? You're playing like 8 roles, you're doing customer service, all this kind of stuff. Early on, we started to see like this was going to work. And in some sense, like, I mean, let's face it, we know people use credit cards. The industry wasn't that advanced. It was like, if you have a cashback card or points program, you could spin it up pretty fast, you were easy, and like the market was easy enough. Okay, we could sell it. It was a working business, and it was going to be competitive. And the way we were going to compete was really on extraordinary talent. So one of the first things, I think our 9th hire, maybe our 10th, was actually on talent explicitly. If we said one of our core inputs was actually going to be on the people that we have. We've recruited some great people who others would want to work with. Some of them are here in the audience. We now are going to have someone who all they're thinking about is accessing is, how do I find the best people in the world? Sometimes they're looking, but most times they're not. And how do you go find them, spearfish, and bring in? And so I think the counterintuitive part, and often you'll see this in second-time companies, is they'll invest much earlier on in just like recruiting, hiring, thinking about it. And so like, it's a little dangerous in that I think some companies can overhire and spend money way too quickly, so I wouldn't apply it in all instances. But if like you have strong product market fit, you understand it, and it's really about people. I think at the end of the day, like, all a startup is a collection of people. You're in a human capital race against the biggest companies in the world too, whether you like it or not. Thinking a lot about how do you identify talent and bring people in and make people want to work for you. And last, we gave much more than recommended in typical equity ownerships to early people, and I think that was, your best employees, what feels like your most expensive hires, often in hindsight are your cheapest because they simply create so much value. So hope that's helpful.
It's a great answer. I mean, if I can add one more thing. I mean, the whole like hiring for spikes is so important.
Yeah.
But I think a lot of people pay it lip service because the way it ends up going is that you do an interview loop, and you'll find a couple of spikes, but then everyone will start talking about the shit that they didn't like, and then eventually the candidate gets vetoed on like the stuff that like the small niggle here, small niggle there, and you kind of end up almost ignoring the spikes. So often when we are talking to SPCs, like you only get 2 votes. You are either pounding the table, and if you're doing an investment, that means you are willing to be their partner, or you veto, right? Like you literally veto. You get nothing in between. Like there's like weak yes, weak no, maybe. It's like you have one of those 2 choices, and if you veto a lot, then that's okay. Well, what's going on there? But like that really is like the only 2 opinions that matter. Like you found something that is so bad that you're like, we cannot hire this person into the company, versus like, wow, this is something that is world class, we want this. Or maybe you had a no signal interview, in which case you should actually recuse yourself from the decision. But that I think is like tangibly what I tell people to kind of do.
Yeah, I love that. Like we definitely would say, if there wasn't someone saying like, hell yes, like I'm gonna hire this person, or I as the manager am gonna commit to make this person successful, and if not, hold me accountable, we wouldn't hire.
Exactly. Yeah. You had a question?
Yes. So what's the attitude you go in with as a founder when you're pitching to enterprise clients? Like, it almost feels like you're this scrappy startup with a new credit card, and people running these big enterprise companies of 50, 60-year-olds with probably a lot of inertia, and they're like, you're this, startup pitching me this credit card, why should I even give you my business? What about compliance? What about safety? Things like that. So how do you go in, how do you land first enterprise customer?
It's a super good question, and like I'll caveat this with saying is like we do now have tens of companies with thousands to 10,000 plus employees using Ramp, and so we've done it. That was not how we started. At the beginning, actually, we found this strange disconnect where once you got the hole in the market, we found was like once you started getting above 25, 30 people, the needs of customers changed from like, I want cashback points, not paying myself enough, I want lounge access and all that, to like, my business works, I'm just wasting a lot. And so we designed almost for like these larger SMBs, small mid-market, who one had this different need, and also they spent multiples times more and actually were willing to upgrade off other stuff. And so we found this hole, there was a much more revenue, and we didn't need as many customers, but we needed to make them feel like the most important customers of the world, and we could do that, and the LTVs was enough to justify it to us. And so we actually tried to find where was the least friction in market to start showing momentum. Again, back to our 10% per week, I'm just trying to grow volume or some indicator enough. I would try to find the most efficient route possible. So that's my this experience with it. When I think about enterprise though, and I think even in first early sales, you want to be solving understanding the problems and talking to enough people to figure out, is this just this unique thing that actually I solved for this one person and it's not relevant, or what are the common sets of problems? And I think in first enterprise clients, ideally, if there's something about them, or if you solve it that you actually think, and you have good reason to believe that solving it for them, 1, it's a great logo, 2, hopefully you can talk about it, 3, you make them feel like the most important client in the world, and in fact, do that, solve for them to make them incredibly happy. Oftentimes it can unlock other parts of the market for you. And look, if someone is giving you a signal like it's going to be a hassle, it's going to be a slog, they don't want to buy it, don't force it. You don't need to be there. They don't need to be there. There's parts of the world who have real pain and problems that are worth solving. Like, get yourself out of situations where there isn't pain or they're not acting your customers, because a lot of people who will waste your time and don't let your team get trapped in that.
I'd also say that a lot of founders, you should you should find the edge here. So you shouldn't lie, but you should really make this shit up as you go along, because I find that too many startups psych themselves out about oh, we are clearly not enterprise ready, or we can't really we're promising this thing but we don't know how to do it. But I think when you do it, more say B2B enterprise stuff, most enterprises are pitching things to other enterprises that they don't actually know how to build yet. So the whole system is a little bit vaporware based, I think. So as a startup, you're just actually, like I can tell them that stuff that I will build in the next 6 months will exist because, and I find that most people psych themselves out a little bit more about the fact that they're a startup, and you're kind of going to walk in and be like, no, I think Eric's point is really good. Like, don't sign up customers that you're not ready for and who are going to distract you, and who might just, it might be a vanity thing. But if you truly think that you're kind of at that edge of like, no, I'm actually a good fit for this enterprise, you kind of walk in there being like, it doesn't matter if I'm a startup or not, right? And in some ways, I might be a better fit because I'm going to listen to you more. I'm actually going to be more receptive to the feedback and so on.
You mean two things? Like, I love that point. Like, I think one of the biggest advantages that like startups can have in selling to customers is like, look, there may be other solutions,
right,
out there. Maybe they've sold all that, but I guarantee you, when this other company, these engineers, product, design, sales team, when they wake up in the morning, I guarantee they might think about you a little bit, not that much. I'm going to go to sleep and I'm going to wake up in the morning and I'll be thinking about how do I make you the happiest customer in the world? How do I solve your problem? Right. And if there's any issues, like I'm going to be up until 3 a.m. and I'm going to make up and over deliver in spades, and you're going to get someone highly skilled, a team that cares and is going to do everything in our power to deliver for you. And that is an incredibly effective and powerful pitch. And so one, you can do that. Two, super agree on the Wizard of Oz, man behind the curtain-ness of like a lot of companies of like it kind of works, you don't totally know, and then you figure it out and then you figure out how to automate it. Like that's a real thing, and it's a real tool that you can keep in your toolkit early on.
I mean, like look at Microsoft right now. They just announced a bunch of Copilot for everything, and I'm just like, I'm pretty sure all that doesn't work Microsoft, but it's great. Like they're just out there doing it, right? And what they're doing is they're psyching out a lot of people from not building that themselves. And I think as a startup, you're just like, actually, no, I'm going to build one thing and build it much better than they can build, and I'm going to be like, that's what I can provide. You had a question. Did you have a question earlier?
You took my first one, so
yeah,
I'll go with my backup.
Okay.
Yeah, I think you sort of already addressed the question with your previous comment, but how has the way you think about competition changed since the early days to now, especially as corporate spend management really picks up?
So funny. So we got this question all the time, right? Like all the time of like, aren't you guys years late to this thing? And I'm like, it's true. American Express did start in 1850. Sorry, some people get the joke, but
yeah,
like,
that's good.
How are you? I just thought the thing was totally strange. If like the market actually was never like winners takes all. It was super profitable. The big issue was like there was no new competition, and even today, as much as we've grown, like I think even the largest startups market share is like probably on the order like closer to 0% market share than 1%. It is this giant market. Most of it is all in like an incumbent's hands. But really at the end of the day, like when I talk to customers, like it's just them and their problems. And the question is like, are we actually going to solve their problem or not? And sometimes it's not us. Often we think it is us. And for customers who use us, they recommend us strongly. But it comes down to like, can we actually solve their problem? And so I think, I think Jeff Bezos talks about this a lot. It's like, there's some companies that are competitor obsessed and some that are customer obsessed. Strongly recommend that you're customer obsessed. Like it is a much better model. And so now and I think most of it, like, and especially in like product and engineering, I actually think it's almost like a mind virus. Like don't look at your competitor stuff once you're starting to build. Because it just distracts you. You don't know who they're serving, what are the decisions, why they did it. Was it a good decision or is it some bad test that you're going to copy? Instead, doing your own work often leads to a much better outcome from first principles.
Yeah. So, and when I talk to startups and they're like, oh, but there's like these 3 other early stage companies that got funded. But I'm like, okay, so they're all pretty low probability, just like you, of not working out. and then they're like, yeah, but there's this Series A company. I'm like, yeah, 90% of Series A companies fail. And then on the flip side, like this big public companies, like, yeah, like you should be beating them. If you're not building a better product than them, then you shouldn't exist. So it's really easy to psych yourself out. I mean, this is the thing I struggled with most when we were building Cove. And it was just like I would constantly keep on thinking about like a funding announcement, a startup, and eventually you're just like, it doesn't matter. Like everybody's either too early or too late, so you might as well be doing your own thing. Yeah. I don't know how much time you have. Do you have a few more minutes?
Yeah.
Okay, just let
Go
let
another
me
10
know.
or so, yeah, no
Okay, cool.
problem.
Go ahead. Sorry, I think you were before. Yeah.
So my question is kind of related to like the sales, go to market.
Sure.
When you guys were thinking about what kind of customer segment to go after, and then also relates to I think the incremental growth thing, like how much did unit economics factor into those decisions? Where like I'm sure a larger client is worth a lot more, but harder to close. Something like interchange. Were there inflection points where the unit economics started to make more sense?
Yeah. So there's a few questions wrapped into it. I think it's a good one. First, we actually, just given like we move like Ramp now moving more than $1 billion a month for customers, and this is not one of those businesses where you can like make it up with volume. Like if unit economics are bad, they're bad, and you don't want to scale the thing because you're just going to run out of funds really quickly. And so early on, we want to make sure we really deeply understood, and even within months, like weeks of being out, our assumptions about unit economics, we could validate and verify. And because there's some cost drivers in there, cashback is maybe one that you set, and once you you can change stuff, but you actually start to drive it. So we want to make sure like our unit economics was like always positive from day one. Next, back to how do you pick the right customers? In some sense, I like the 10% per week kind of algorithm of like, you're trying to grow that, and so you're figuring out like path of least resistance coupled with like probability to close. Like you might have like a massive account, and we had one before we launched. There was one account spending $1 million a month, 10% chance of close, but if we do it, it was great. Probability weighted, maybe that's worth $100,000 a month in terms of spend. There are other customers where if you spent some time, 50% chance to close, a lot smaller line drives, and our job was not to, again, 10x or 50x or whatever. It was to get it done this week. And so I think to avoid giving one size fits all, I think coming back to that, like how do we optimize once you have a working model, growing a little bit on it and constraining the problem will lead you to what is the right place. So kind of bottoms up, follow that, and then couple with, again, top down of does this model make sense? These core assumptions that I'm making, if I check them a few weeks later, are they right or are they wrong, and do I need to revisit? And it's kind of that simple iterative loop, I think, will help get you to where you need to go. Yeah.
I'm gonna go one to him and then I'll come back to you. Okay. I've been focusing on questions from the
I feel like at the early stages, the big uncertainty was like, how much money could I save for potential customers?
Sure.
And so I'm curious, at what point, was it obvious from the first expense report you saw, or what point did you get conviction that wow, there's actually a ton of waste here that we can help cut down? It's meaningful ROI that is actually going to result in massive traction.
Totally.
Yeah.
It's so it's pretty fun. Anyone who's ever worked at a big company or meeting company knows these things are crazy. They're very inefficient. There's a lot of waste that was there. Often at the beginning, it just was, could you convince someone to trust you or to give you an opportunity to find savings for them? And there's some companies that wouldn't, but other early stage startups said, we're busy enough. If you'll go try to solve this problem for us, have at it. And we started to see at a certain scale, we couldn't really find savings, but once it started to get to a certain scale of companies, usually it was this seed to Series B company, almost certainly, if they sent over a card statement, we were gonna find savings. Next, what was interesting is part of the Ramp model and credit card model is there's interchange. We're a free product that can actually pay you to use it and even have funds left over. And so some of this was actually, how do we just find, instead of boiling the whole market, how do I convince you, the customer, that you're going to get value out of this experience with Ramp, and just solve for that, continue to grow. We also believe that the more data we had, the more savings insights we could find, the more friction we had on our product, the more we could actually build useful software that would automate expense reports, help automate accounting, all that. And so part of our early algorithm was, okay, we knew the business model would work. We just need to figure out, can we sell this thing? And the way we'd sell it is showing savings or value. And so we just, got over it with elbow grease at the beginning till eventually we built standardized, simple software that could take over and a brand that people would say, okay, well, there's 100 other companies using this, or 1,000, my friend told me about it. Or I sent them my financials and they came back and they showed me how to save $10,000. I felt that was great. I'll trust them. I'm going to go and build with it. And so, again, it wasn't trying to, how do I build one weird trick that, saves everything, or one set of software that solves the market. It was really of how do I find some customers that I could actually help. They trusted our infrastructure to be dependable enough and were willing to take a shot on us so we could get to the next stage.
Maybe one last question, and we'll go to this gentleman in white.
Thanks, Eric. So you mentioned low interest rates being something that was beneficial to the business. What other things out there, whether it's infrastructure, regulatory, whatever it is, like made it the right time for companies like Ramp, Rex, all the other like FinTech incumbent or FinTech disruptors? Like, what made it the right time to start a company like Ramp and to scale it to the point that it is now?
Totally. So I think there was like 4 factors that just like opened the market for us, and once they all, probably 2 or 3 of them were sufficient. But I'll talk about it. So the first was like something that's very unusual about a lot of financial services is like it's like that and healthcare are like the biggest sectors of the economy, but there's like not new competitors. Like most of my competitors, founders, like literally wore top hats. Like the world went from like no phones to flip phones to iPhones. Like the credit card didn't change, the bank account's basically the same. And a lot of the reason was if you want to offer a credit card and monetize in this way, historically you had to be a bank. A lot of regulation coming out of the financial crisis was really focused on the too big to fail problem. And there was some regulation, we've written about it on our blog, but this thing called the Durbin Amendment, where Senator Durbin basically was trying to go after and figure out how do we cut down consumer interchange, but also prop up small banks so that they would make enough so that they could compete. This created this incentive for small community banks, whether it's Sutton or Celtic, or there's lots, thousands all throughout the country, where if they could just simply convince people to use their cards, they could make more interchange. It's, Ohio's wonderful. It's hard to convince people to move there and use your local community credit card, but it actually gave them an incentive where if they could actually start to work with infrastructure providers and get people to create cards with them, they had a real economic incentive. You started to see, so that was the first one. There was a regulatory change. You started to see infrastructure providers realize this. So Square early on, Stripe, people figured out if I could go create a new credit card or monetize financial products, infrastructure, one, the banks were willing to co-brand or do things together, but started building standardized infrastructure where I wouldn't have to go and build everything from scratch, but I could actually just go and call an API, and there was infrastructure ready to go in a partnership model. Cost of capital is a third factor dropping. When you think about interchange, in order to make $2 million plus, you might need to cycle through $100 million. It's an expensive business to scale. You need a lot of capital and resources, and historically, if you were a bank, you'd fund through deposits, but now if rates are low, borrowing is not very expensive. And so that meant, you could work with small banks. There was infrastructure you could call through an API. And last, one of your core costs actually was not super high, and big banks wouldn't have a mega advantage. Last, in underwriting, if you want to go and extend $100 million, easy to lend, harder to get paid back. Historically, people would underwrite based on lots of credit factors, and you would need years to figure out if someone was a good or bad credit, and lots of data. The proliferation of companies like Plaid or Finicity, meant you could live link to someone's bank account, and rather than trying to underwrite years of credit history, you could underwrite there's a pile of cash. It's not moving that quickly. What's the chance that at least 5% of it is here in a month's time? Pretty high. And so suddenly you had all the ingredients fall into place. And we saw that unlike Capital One, which had to give away almost the vast majority of the company to 10,000 people. You had to spin it out of a bank in order to start it. You could, with 4 years ago, a few people starting a company out of an apartment 10 blocks from here, actually have a product that was just as good, and in some ways a lot better and a lot more useful to companies in a few months' time. And so I think when you get close enough, sometimes in some ways by being at a credit card company, I was able to start to see that and think through what were the changes. Knew a lot about savings and tried to apply it, but there's interesting things happening in lots of different industries, and I think there's still a mega opportunity in financial services. It is still an industry that has seen so little innovation compared to the rest of the world that it's shocking. Some good reasons for it. Others, not really. There's just a lot of inertia, and I think there's an opportunity to open up. But I think there's lots of other industries where changes like this happen. So anyway, hope that's helpful.
Okay. I think we'll take that as a wrap. Thank you so much, Eric.
Yeah.
Thank you.